Everyone is celebrating the gold rush. But nobody noticed the mine has already collapsed. Since ChatGPT launched in late 2022, the market value of AI-linked companies has surged by $19 trillion. It is the greatest creation of wealth in human history. There is just one problem. According to a confidential November 2025 analysis by Goldman Sachs, the actual economic value of that technology is only $8 trillion. That leaves an $11 trillion gap of pure air. But it gets worse. According to Vanguard's confidential 2025 outlook, U.S. equities have officially hit the 99th percentile of valuation. We are literally 1% away from the absolute mathematical limit of overvaluation. We are standing on the ceiling, and there is nowhere left to go but down. To understand why the math is broken, we have to look at the fallacy of aggregation. Goldman Sachs analysts explicitly warn that investors are betting on every company in the AI stack, the chip makers, the model builders, the cloud providers, to win simultaneously. But the market isn't big enough for all of them to justify their valuations. In mid-November 2025, Goldman's Dominic Wilson and Vicky Chang ran the numbers. They estimated the present discounted value, essentially, what this tech is actually worth in future revenue, at a baseline of $8 trillion. But the market has priced it at $19 trillion. As Goldman puts it, we are at the upper limit of projected macro benefits. They compare this directly to the innovation booms of the 1920s and the 1990s. The innovations were real. Electricity was real. The internet was real. But the markets overpaid for future profits. We are paying for a revolution, but we bought a bubble. And unlike previous bubbles, this one is fueled by a level of spending that borders on insanity. While Goldman looks at the valuation gap, JPMorgan is looking at the spending, and the numbers are terrifying. Jacob Manoukian, U.S. head of investment strategy at JPMorgan, highlighted that large tech companies have tripled their annual capital investment, from $150 billion in 2023 to a projected $500 billion in 2026. To put that in perspective, AI investments are currently contributing more to U.S. GDP growth than consumer spending. But here is the smoking gun that nobody is talking about. This entire $500 billion AI build-out was planned for a world of cheap money. That world is dead. Vanguard confirms that the era of sound money is back. They project yields will remain above 4% across the curve. Why does this matter? Because AI companies are borrowing billions today to build a product that Vanguard says won't generate significant productivity until the late 2020s. Borrowing at 4% to chase profits that are 5 years away isn't an investment. It's suicide. But stock prices are just numbers on a screen. The real bloodbath is happening in the real economy. While investors pray for returns, AI is quietly dismantling 5 specific sectors. Goldman's labor market analysis has identified industries where employment growth has already fallen below trend. This isn't a prediction. It is happening right now. Number 1, marketing and consulting. Efficiency gains in content creation mean we simply need fewer humans to sell products. Number 2, graphic design. Hiring for creative roles in the tech sector dropped 25% between 2023 and 2024. The entry-level job is dead. Number 3 and 4, office admin and call centers. Goldman specifically flags telephone call centers and scheduling roles. Global surveys show 41% of employers plan to reduce headcount within 5 years purely because of AI. And number 5, IT services. This is the counterintuitive one. Goldman found that employment in computer systems design has slowed sharply. Why hire a junior coder when the AI writes the boilerplate code for free? The tool that was supposed to help developers is slowly replacing them. Goldman estimates up to 300 million full-time jobs globally could be exposed. You might think the CEOs know what they are doing, but do they? In November 2025, Sundar Pichai, CEO of Alphabet, told the BBC that this trillion-dollar boom has elements of irrationality. When asked what happens if the bubble bursts, he didn't mince words. He said, "No company is going to be immune, including us. The smart money knows the party is over. That's why Vanguard's long-term forecast for U.S. stock returns has dropped to a shocking 0.7% to 2.7% per year for the next decade. Adjust for inflation, and you are guaranteed to lose money for the next 10 years if you buy at these levels. The growth trap has snapped shut." The history of financial bubbles teaches us one thing. The innovation usually survives. The internet survived the dot-com crash, but the investors who bought at the top? They didn't. We are sitting on a $19 trillion pile of expectations, backed by an $8 trillion reality. The music hasn't stopped yet, but the exits are getting smaller. Don't be the one left holding the bag.